Hey everyone, this is Jackson with the Wealth Squad. Today we'll be talking about what you should be doing in markets like these. Markets that are just bouncing back and forth, showing no real direction. Right now we're looking at Facebook or Meta platforms, whatever you want to call it. You could see it's the same price as it was July 2017. It is now July 2022. 5 years of gains, non-existent. Facebook has never paid a dividend, so you have gotten no income in this time and no appreciation. Of course, you could have sold a couple months ago, but if you held this 5 years exactly, you're making $0. So that might be hard for a lot of people to understand, considering the S&P 500. You go back to March 2017. I'm sorry, July 2017, and we're up from 246. We're up 56%. And we go to Apple. And we see here 36 to 144, up 300% in Apple. And Apple was a huge company back then, even. And it's just hard for people to understand that not all stocks, especially the big ones, are the same. It's hard to understand that because the SP 500 is built up of these stocks. Sure, a lot of the allocation is from the bigger companies. That makes sense. It's a market cap based index. However, one company going berserk and one company falling and not making a single cent in 5 years does not crater the market. It craters that stock, but the index stays alive because you have companies like Apple. Sure, Facebook's down up 0% in the last 5 years, but Apple's up 300, so it makes up for that. Then we have Netflix, another one that's just been a bummer. I'm sorry, Netflix. We go 5 years. July 2017, and we're up 19% from the bottom of July 2017, about July 1st, 2017. You're up 19% 5 years later. At one time, you were up 361%. So Netflix is, disappointing what we could be doing in the SP 500. Google, on the other hand, making up for it. Once again, companies that go under are made up by companies that have been doing well. And we see Google up 150% in that same time frame, where Netflix is up 18, Facebook is up 0, and then of course there's companies that are the IPOs, the failed IPOs. We have Uber, where it's May 2019, basically nothing in 3 years. Lyft, down in 3 years. We have Airbnb that just went public last 2 years, so basically December 2020, now in the negatives, under $100. We have Peloton, which was huge and then collapsed from 160, 170 to now under $10. Then we have companies like Roku, which was ginormous, right? $500 stock, now under $100. Company like SE, once $350, now under $100. The list goes on and on and on and on. And these are companies that are smaller, so the index is not really affected. Maybe a couple 0.05% maybe by the complete collapse of Roku. That type of allocation, because it's market cap based. If Apple's worth 2.5 trillion and Roku is worth 100 billion and Roku collapses, well, that's Apple falling a few percent. That's not a big deal, and the market won't react like it's Apple falling 100%. It's Roku, right? It's not that big of a deal for a company that small. Same with Square. Square was a benchmark financial stock back in August for 250, 260. Is now down to 60. Eliminate the 2, you're at 60. You lost $200 a share. Back to prices, let's see here, May of 2018. And it's not pretty, it's not anything glamorizing. I'm talking about a lot of people lost a lot of money. What I am saying is the only way you can make money in this market is to dollar cost average. Buy once a week, once every 2 weeks. Let me take this out of here. Once every 2 weeks, maybe twice a month, 24 times a year, maybe 36 times a year, once a week, 52 times a year. It doesn't matter as long as you buy often. Let's turn this to auto, and consistently. We have the S&P 500 here. Sure, from 2017, we are up only 56% compared to Apple, but who knows if Apple's the next Facebook or Apple's the next Netflix and collapses 70% from here. We don't know that, and that's the part of your portfolio that should just be individual stocks. You should have majority index funds. If you're conservative with your investments, of course you should have majority index funds. But if you're average, you're going for moderate risk, maybe half index funds, and then the other half is a wide selection of different stocks that you like. And then a completely different scenario, you have Bitcoin, Ethereum, and then a wide selection of different cryptocurrencies that you like. There's always benchmarks. There's always these stocks that you want to have a position in, the S&P 500 being one of them. Even when the market is like it is, many tech stocks are down 80% from the highs. We can see here S&P 500 down about 20%. Then you have the tech stocks. The tech stocks allocation hurts QQQ the most because it is a NASDAQ 100. Instead of 20%, we're down almost 30. And looking at individual stocks, that's where the real risk comes in because you have no other allocation. If you buy one share of Shopify compared to one share of, let's say, QQQ, you're only getting Shopify in this example. When QQQ, you're getting hundreds of different tech companies all doing different things. Shopify is down 80%, but the tech index only down 30. The S&P 500, more moderate than the tech index, is only down 20. The Dow Jones, we could see only down 16 max. The Dow Jones is one of those where it's more like a GE, or once was a GE. Those companies, like there is Apple in there, like Home Depot, not the fastest growing companies on planet Earth, but consistently growing companies that have outperformed others in the past. So and there's 30 of them in the Dow, 500 in the S&P 500, and the NASDAQ 100. So the more allocation that you have, not necessarily the better, but when it comes to S&P 500, you have companies that represent 0.01. And if that collapses, 0.01 of the S&P 500 is gone. And that's nothing. That's nothing. It moves like that on a regular second of a regular day. What you should be looking is the big allocators in the different indexes. I remember at one time, Apple represented 10% of the QQQ index fund, or Amazon, had 10%, and that's I think that's too high. That's up to you what you think, but there is a way you can look at each ETF and see for yourself. I'd recommend you do that because not all ETFs are built the same. I'd recommend the S&P 500 over most, and you can sprinkle a little QQQ in there, sprinkle a little Dow Jones, and sprinkle a little individual stocks, and I think you'll be just fine. That's what I think you should be doing in this market. It's a lot back and forth recently. Just buy index funds, dollar cost average. For me, I have $500 a month auto invested into index funds that I do not see, while I also play with individual stocks. So let's say I go broke trading stocks, at least I have these index funds to back up my future retirement, if you'd like, or my future down payment on a new house for my family, that type of stuff. So I hope you guys learned something from this video. My advice, dollar cost average. eliminate the stress, start making money elsewhere, put your money into the market passively. That's what I would recommend to you. Hopefully you're on the same page with me. If not, comment why. I'd like to hear it. Thank you so much. And I will see you on the next video on Wednesday.